Welcome to Finance at the Jobsite, the podcast where construction finance meets the field. I'm your host, Rishi Srivastava, founder of Being Human. In each episode, I sit down with construction CFOs, controllers, owners, project managers, IT leaders, ERP consultants, and industry experts to uncover how they connect the back office with the field, choose and implement technology, manage cash flow, and drive profitable projects. Whether you are running the numbers, leading the team, or designing the systems that keep projects moving, this is your place to learn what's working, what's broken, and what's next in construction finance. Today, our guest is Cody Daniels. Cody, welcome.
Yeah, thanks, Rishi. Happy to be here. Happy to chat with you today.
The first section here is on back office and operator playbook. When a $1 million to $30 million GC calls you mid-project saying cash is tight, what three reports do you open first, and what red flags do you look for in each?
Yeah, first, I think we're going to jump right into the AR aging report. And what we're going to look for is, what receivables do we have that are, maybe 60 plus days outstanding, and, work to determine if there's anything we can do to accelerate the collections on those. In my experience, most contractors are not out there overspending. So when cash flow becomes a concern, it's typically because they're not receiving payments quickly enough. They have slow paying clients, and that tends to drag things down. So that would be my first report is AR aging, and we're going to look at the things that are a little bit stale and try to collect those. From there, I'd probably look at their WIP schedule and determine if they're underbilled on jobs. Obviously, the AR aging is going to let us know if we have billed jobs and whether or not we've collected those. But the WIP schedule is going to tell us if we're behind on billings and haven't sent invoices out. And obviously, if we don't send invoices out, we're not going to get paid. So I think those two reports for most contractors are going to address, the vast majority of kind of cash flow type issues. From there, to me, it would be a little bit more contractor specific. What are we going to dig into? We're certainly going to look at job costs, and we're going to look to see if cash outflows are consistent with expectations. Do we have materials costs that are exceeding our expectations? Do we have jobs where we're expending significantly more labor than projected? So we do want to monitor the cash outflows as well. But in my experience, it's more of a cash inflow issue for most contractors.
Inflow is tough. What's the most common chart of accounts mistake you fix for growing contractors? And how does that misclassification ripple into bad job cost decisions?
Yeah, I've seen this with a number of clients that I've onboarded here in the last few months, and it's that they're not breaking expenses into different accounts. And what I mean by that is, they're typically dumping all of their accounts into a single account on the chart of accounts, and the direct costs, maybe it's field wages are not being shown under cost of goods sold, or the indirect costs are being grouped up with cost of goods sold. And really, those items need to be split. And payroll is almost always one of the most common instances of that issue popping up. Is all the payroll goes into one expense account, and we really need to be splitting that out. In the job costing issue that can cause is if you don't have a good handle on wage costs versus your indirect wage costs, it's going to make it much harder to accurately bid jobs. You're not going to know, obviously, again, what the direct costs going into that job are and how you need to calculate those. But for the clients that I've been working with, they don't have a good handle on their overhead. And so they're frequently not factoring in that overhead rate, into the bidding on a consistent manner. So being able to come in and split those costs in between like a direct cost and an indirect cost. And there's a lot of costs that sort of tie into that. If it's payroll that's being lumped into one bucket, typically payroll taxes are being lumped into one bucket, other employee benefits, insurance, retirement plans, it's all getting dumped into a single bucket. Really, we got to be taking the time and effort to split those up so that we have accurate job direct costs and accurate overhead costs so that we can bid more accurately. And then also, I think a lot of this classification helps us with our cash flow. If we know what our overhead costs are, and those are typically pretty fixed, that's going to help us more accurately project our cash flow out into the future. And especially during the slower, seasonal times, for some of these clients, it's been real eye-opening for them to see that these are the costs that I need to cover during the off season when all my crew is laid off, but I have office employees and things like that. I need cash to cover that, and being able to split that out for them really helps kind of illustrate that.
Yeah, this splitting that you're doing is so important, not just for bidding, but also for this kind of situation where office people are still there when the crews
Right.
kind of let off. Walk us through your month end in 48 hours checklist for construction. What's mandatory versus nice to have to keep field and finance in sync?
Yeah, I'll start by saying that to do a true close of the books is probably for most contractors, it's not realistic to get that done in 48 hours, at least in my experience. There's probably some, larger contractors that have the technology and infrastructure to close their books pretty quickly. The types of clients that I'm dealing with are, they're smaller mom and pop type businesses. Most of them are using like a QuickBooks or, some other kind of comparable software. And so, for a lot of them, just to get the WIP schedule might take a couple weeks, aggregating that data, checking in with the PMs to check on the status of jobs and things like that. So I would say for in an ideal world, within 48 hours, if you can at least get all your transactions categorized and into the right buckets, and then reconcile your cash and your credit card accounts, for a lot of small businesses, that's going to give you the data you need to make a lot of decisions on. It's not going to be perfect. It's not going to be a full, true financial statement, but that's going to get you to a point where you can make a lot of informed decisions. If you could get this done in 48 hours, what would be nice to have, I would say, is, reconcile your loans, make sure that you're reconciling those accounts as well. If you can get the WIP schedule updated and get the WIP adjustments posted to the financial statements, that would be great. And from there, reviewing budget versus actual by job and, maybe spot checking some, some other categories within the financial statements, checking in on your AR and your billings, checking in on AP to see where that stands. And, if there's any fixed assets, CapEx, things like that, again, kind of reconciling that. But for me, the types of clients that I'm working with, typically sub 10 million contractors, if we could at least get the categorization taken care of and the basic reconciliations within 48 hours, that would put you ahead of a lot of your competitors.
If you could standardize one web schedule habit across every subcontractor you work with, what would they be and why?
Yeah, that's a really interesting question, and I'm going to come at this in a way that I think is going to be a little bit unique. My background is primarily on the tax side of accounting, and this definitely ties into tax planning and preparing accurate tax returns. I would create a standard format for numbering your jobs on your WIP schedule. And for me, that standard format is using the year that the job started as the first two digits of the number that you assign to that job. So for example, your first job of 2026 would be 26-001. Next job 26-002. And the reason that I like including that start date in there is that's what drives a lot of our tax planning decision making. That's what really makes construction tax uniquely different from any other industry. If you have a job that starts in one tax year and finishes in the same tax year, the tax treatment of that job is going to be consistent with what you see, applying to other businesses, whether it's, like professional services, manufacturing, things like that, that the tax treatment's going to be pretty consistent. When you start to have jobs that span tax years is when the construction specific tax laws start to apply. So a job that starts in December and ends in January, even though it's, a 2-month job, it spanned tax years. And that's when we have to start applying the really unique tax laws that are applicable to contractors is when we have those jobs that span tax years. For me as a tax guy, looking at a schedule of WIP, knowing when the job started helps me to better analyze that job and think through creative tax planning opportunities there, determining when certain mandatory treatments are required versus exceptions to the general rule that we can apply and things like that. So yeah, it's just kind of a little bit of a unique take on it, I guess, to sort of help with the tax planning, because otherwise I'm going to have to go through with the business owner or, project manager, internal and get that information from them separately anyway. So this just sort of alleviates that interview process.
Yeah. Communicating information clearly is so valuable. The next section here, Cody, is on taxes, planning, and advisory. For an owner adding a second crew and a new truck, what's your high level decision tree between bonus depreciation, Section 179, or straight line? And how do you explain the trade offs without tax speak?
Yeah, that's another great question, and I guess before I get into that, I'll just remind the folks listening what the kind of differences are there. Bonus depreciation and I'll probably get a little bit into tax speak with this, but it's hard not to. Bonus depreciation applies to asset purchases and allows you under current tax law to write off 100% of that asset. Section 179 is a formal election that you have to make on an asset by asset basis. So it differs from bonus depreciation in that bonus applies to all of your assets by default. You would have to choose to elect out of bonus depreciation. Section 179 is a little bit different in that you have to affirmatively elect it on individual assets. And then straight line is exactly that. I mean, you take the tax life of the asset, be that 5 years, 7 years, and you divide that among the cost of the asset, and you take an even amount over that time. So for me to analyze what of those options makes the most sense, so the first question I'm going to ask is, do we need the tax deduction this year? And that may be a tax planning decision, but it's also frequently a business decision. So I'll give you an example. Working with a construction client, their priority throughout all of our kind of initial discovery meetings and onboarding meetings has been minimizing taxes. That's been a big priority for them. Well, we get into our year-end tax planning meetings and we include their banker in one of the meetings. And he says, guys, we can't show a loss for tax purposes. Looking to get some SBA financing next year for a building that they're looking to have constructed. And we need to show taxable income on the tax return in order for this financing to go through the way you want it to. So now, instead of looking to maximize tax deductions, we're looking to be strategic to minimize taxable income but ultimately still show some taxable income on the tax return so the SBA is satisfied and can work with them on the financing that they need. So question one is like, do we need the deduction this year, or is this something that we can choose to not maximize our tax deductions and maybe push some of that into the future? Along with that is kind of an analysis of just where they're at currently and whether or not they'll get the benefits of those deductions. So one of the differences between bonus depreciation versus Section 179 is that bonus depreciation can create a loss for tax purposes, but Section 179 can only drive our income down to zero. Like it'll max out at a zero break even taxable incomes. Trying to balance the benefits there. If we create a loss for tax purposes, do we have other sources of income that we can offset? Versus 179, we know we're going to be, kind of capped at zero. The benefit of something like Section 179 is that from a state tax perspective, more states follow the federal Section 179 rules than follow the federal bonus rules. Again, optimizing between federal and state tax liabilities becomes important. While bonus may be hugely beneficial from a federal standpoint because it can drive our income, into a negative, if we have to add back all those deductions at the state level, then we end up with potentially a large disparity. We end up owing significant state taxes. Maybe something like a Section 179 where the state might comply becomes a little bit more of an appealing decision right there. So yeah, there's a lot of factors that go into it, and it's really just kind of determining what's important for the client and what's going to get them the right answer in the current year.
You know, uh, Tax planning, if you are strategic about it, it also gets super complicated.
It's one of those things where it's hard to give a good answer to a wide audience because everybody's situation is unique. I mean, every tax
Yeah, yeah.
situation so specific, and what works for one taxpayer may not work for another. And so that's really why you do have to invest the time in going through it. And Using, like search engines or like even like a chat GPT or something, it's probably going to overlook the nuance or the idiosyncrasy of your specific situation. And that's where bringing in an expert kind of, helps tie everything together so that you're making informed decisions.
Yeah. AI is only as good as the expert who it is reporting to.
That's right.
Cost segregation comes up a lot in our audience. What's a quick litmus test to know when it's worth pursuing on yards, offices, or mixed use build outs?
Yeah. So it used to be the cost of the property was really kind of one of the driving factors there. And you had to probably be over $1 million in purchase price on the building for it to make sense. But, things have started to change in terms of, our ability to execute on cost segregation study projects, as well as just again the tax environment that we're in right now. In July of 2025, we had the One Big Beautiful Bill Act that was passed, and that brought back into the fold 100% bonus depreciation. And with 100% bonus depreciation, for me, all buildings are at least worth considering a cost segregation study on now if you're going to hold the building for at least a decent amount of time. So for me now, the litmus test is not really the cost. It's really how long are you going to hang on to the building. If you're somebody that's flipping buildings pretty quick, you accelerate a bunch of tax deductions into year one, but you sell in year three and recapture all those tax deductions. It really didn't benefit you all that much to have done the cost segregation study. But if you're going to hold on to it for 5, 10, 15, maybe even longer, you're really going to get the benefits there because you're front loading up to, I would say, 20 to 40% of the purchase property could be written off in year one. You're front loading those deductions and you're getting to hold on to those tax dollars for a longer period of time before you start to recapture on the date of the sale. And that really is for me when the analysis becomes like pretty obvious that it's like, yes, we should move forward with this. If you're going to hang on to it for any more than 5 years, it's probably worth it. But even low dollar properties now, I mean, we're able to do cost segregation on, 250, $300,000 properties. I literally just did one on $125,000 property. And we're able to do these in a manner that it works for anybody.
What's the most overlooked entity structure or owner comp tweak that improves after tax cash for small contractors without adding complexity?
Yeah, I guess I'll start by saying that, complexity is all relative. So what's complicated for one business may not be complicated for another business. So, let's say you're a startup contractor, one guy in a truck out there doing all the work on your own, setting up payroll under like an S corp structure. That's going to add a lot of complexity for you. It may be beneficial to retain that sole proprietorship Schedule C business structure for a little while to keep your compliance costs down, to keep the complexity down. Consider that S corp election when the business starts to grow, you have more profitability, maybe you start to take on some employees. If you're somebody that's already using that S corporation structure, taking the steps to really dive deep into your owner compensation is much less complicated at that point because you're already paying yourself payroll. You're already filing payroll tax returns and things like that. I think if you're at that stage, working through like a reasonable compensation analysis, to make sure that you're paying yourself a compensation that it can be defended in front of the IRS as reasonable, but you're not overpaying in compensation can be a really smart strategy to minimizing your overall tax liability. The play there is obviously minimizing payroll taxes, Social Security and Medicare and things like that. But certainly digging into that can be very beneficial and kind of to piggyback on that, because I've done this S corporation analysis for a couple clients this year. It's not just the savings on the payroll taxes that factors into this. There's this optimization of the qualified business income deduction. Some people call that 199 cap A. And what that is a 20% deduction of any flow through taxable income to a business owner via like a K1, or again, if you're a sole proprietorship, your business income So it's an opportunity to exclude up to 20% of your business income, but it's subject to limitations. And one of those limitations is your total wages that are paid out. So for certain businesses that may have relatively low payroll, paying yourself some additional compensation can help you to get more of this free 20% deduction. And so optimizing between the payroll taxes and this 20% income exclusion becomes a little bit more of a nuanced analysis that we can go through for clients and kind of determine what makes sense there. Because with this 20% deduction, it may not make sense to drive your wages as low as you reasonably can. It may make sense to pay yourself some wages to try to optimize that deduction. Another area that I think is worth, looking at and maybe more broadly applicable from like a compensation structure is just, making sure you're considering retirement planning as part of your tax planning. So the conversation I have with contractors all the time is, well, should I go buy a truck before the end of the year to help minimize my taxes? And while if you need a truck, that's a potentially great strategy to go out and spend 50 grand on a truck and you can finance it. So maybe you're not coming out of pocket 50 grand. You're kind of, spreading out the actual cash outlay there to accelerate that $50,000 deduction. And something that I think is worth considering is, well, what if I put that $50,000 in a retirement plan for myself? I'm still getting a $50,000 tax deduction on my current year tax return, but instead of paying Ford dealership or, whatever, kind of equipment dealership you're buying fixed assets from 50 grand, you're now paying your future self 50 grand. And so you're still getting the same tax deduction, but who gets to retain the money in that situation? You're paying yourself in that situation. And so that's, something I've started to try to sell more clients on is if you need the truck, yeah, let's talk about buying the truck. But if you don't need the truck, like let's put some money away for our future self while still minimizing our current year taxes.
Yeah. The next question is, suppose a contractor is scaling from $5 million to $15 million. What quarterly tax planning rhythm do you set so year end isn't a panic?
Yeah, so I think for me, quarterly tax planning can be challenging in the construction space because it's a very up and down and seasonal type of industry. So for Q1, it's, let's get our prior year tax return in order because that's going to be our starting point for planning for the upcoming year. So if we can get our tax return done in Q1, great. If we can't, let's get everything that we have together to make as educated a guess as possible what our taxable income is going to be, and then put our tax return on extension. And then based on either the final tax return that we filed or the like draft of our tax return that we use to extend, we should have a decent idea of what our tax liability for the prior year is. And that's always our starting point for estimated tax payments. There are a couple different ways that you can determine your estimated tax payments throughout the year and pay those in to ensure you're not subject to additional penalties. You can calculate your income every quarter and pay in based off of that, or you can use your prior year tax liability as a safe harbor. So you can take your prior year tax liability. For most taxpayers, you're going to take it times 110%. So if you owed $100,000 in taxes last year, you take it times 110. So your estimate's going to be $110,000 and start to pay in quarterly based off of that. Um, for a lot of clients early in the season, Q1, we're very optimistic the year's going to turn out good. Even if Q1 starts out kind of slow, we're still feeling optimistic. It's early in the year. We know that we're gonna, pick up and we're gonna, continue our growth projection and all that. So for most clients, unless they had some extraordinary event that caused their tax liability to spike in the previous year, we're going to use that safe harbor methodology and start paying an estimated taxes based off 110% of last year. Once we get into Q2, we may start to do some more in-depth planning, but we're still pretty early in the year. So it's typically like a mid-year check-in. We're looking out for, again, like big ticket transactions that are kind of unique. Maybe we sold a building and we have a big capital gain from that, or we have some investments that are doing really well and we start to sell those off, or, just looking out for those kind of unique items and planning around those. Maybe you bought a building and we're going to do a cost seg on it, and then we're going to use, those accelerated depreciation deductions to help minimize things. So, we're starting to look at things there, but we're probably not deviating too much from that kind of set safe harbor estimate that we put together early in the year. Q3 is really for me when it starts to get fun. We have pretty good data at that point in the year, and we can start to really kind of do some earnest projecting and forecasting through to the end of the year. And that's where we can start adjusting payments if things are shaping up differently. If our income is trending higher, we just stay on that safe harbor path, because what that allows us to do is pay in based on a lower tax liability. And there's no requirement if our income, in a given year is significantly higher than the previous year to pay in that extra early. We don't have to do that. So let's keep the cash in the business. And, if the year turns out well, we owe that tax early in the following year. But if the year is trending not so good at that point in Q3, then we can start to scale back our estimates based on what we've paid in early. And at that point, we have, again, some strategies that we're probably looking to implement. We're probably starting to look at, should we buy equipment? Are there some credits that we should be going after? If we're utilizing the cash method, as the vast majority of small contractors are, like, what are we looking to do from that perspective? Are we looking to pay down payables to accelerate the tax deductions? Is that not necessary? So those are the conversations we're starting to have in Q3. And then Q4 is typically refining. Again, we're updating for our year-to-date financials. We're, again, revisiting those earlier Q3 conversations, and we're looking for those, again, kind of final action items that we want to tick off before the end of the year, as far as, again, paying things down, buying equipment, etc.
Actually, on my personal tax return, this is the first time I got a penalty because of estimated tax. I always ignored the estimated tax stuff. I'm
Yeah.
like, whatever, who cares if it's estimated tax thing?
Well, it's one of those things that historically it had been pretty cheap to quote unquote borrow from the government. So it had been relatively cheap in years prior to forego estimated tax payments, keep that cash in the business, and then figure it out closer to the end of the year. Because it's expensive to go borrow money from the bank and, manage the cash flow and all that. And, for most small businesses, they're a sizable expense if you're running a profitable business. So again, historical rates, it was cheap to do that. Now, interest rates that the IRS are charging is starting to go up. They're starting to charge greater, penalty rates, and now it is more of a meaningful decision to start to look at that. And that's one of the hardest things I see for like new construction companies. Somebody that's jumping from their W-2 job over to entrepreneurship, and they're not paying their taxes through withholding like they used to as an employee, and so that becomes a surprise at the end of the year. It's like, oh, I haven't been paying taxes, and now what do I do? So yeah, that's why we're monitoring this. Tax planning is not a once a year thing. It's a thing that you should be doing throughout the year. And if last tax year didn't go the way you wanted it to, starting as soon as you can for this coming tax year is really important, because a lot of these decisions are timely. If you want to change your entity structure, there's a certain time that you really should be filing those elections to change your entity structure and things like that. So it's very easy for your CPAs and your tax professionals to help you on the front end. When the writing's on the wall and things are set in stone after the fact, our hands are tied in a lot of cases. It's much more difficult to execute on some of the fun and creative strategies that we know are available. We just got to be doing that, timely.
Yeah. The next section here is on growth, marketing, and the builder's CFO lens. You've been building a focused construction practice. What referral flywheel has actually worked? Bankers, bonding, payroll, attorneys, and how can a contractor tap the same network to improve financing terms?
Yeah. So for me, I'm going to give you the surprise answer first, and then I'll get into I think more the maybe traditional or expected answer to that question. I have surprisingly got a decent amount of leads from other CPAs,
Hmm.
which I think might shock some people out there, but I think there's some some change happening within my profession, within the accounting, industry, where there's a lot of work to go around and not a lot of supply to execute on the work. So I think firms are becoming a lot more collaborative in that, they're recognizing not every client is a good fit for them. So like, let's make an introduction to somebody that, can service them well. There's a lot more, I think, specialization happening at smaller firms like where we realized that again we want to serve a specific sort of client profile, and things that fall outside that we can refer to somebody else that we know is going to take care of them. So that's been a surprisingly beneficial kind of relationships to cultivate, or a referral community to cultivate, as the other CPAs. Not everybody wants to work with contractors, which I don't get, but for whatever reason, some CPAs, they want to work with other industries, and they're happy to pass the contractors along over to me. So that's the surprise answer. The more traditional answer, obviously referrals from existing construction clients are huge. Other professional services and folks serving the construction industry, bonding agents and bankers have been really good for me, because they can spot some accounting problems before, maybe the business owner realizes it. So if you're, presenting your financial statements to get a line of credit or to get bonded, those people are going to look at the financials, they're going to look at your tax return, and they're going to start to notice that, things maybe aren't is in as good a shape as they can be, or that, maybe there's things that don't make sense there. Oh, what do you mean your accountant's not preparing a schedule of WIP for you, and they're not booking the WIP adjustments? Like, you don't have true percentage of completion financial statements. And that's what that's what the bankers and the bonding agents want to see. So they've been really good resources for me, because they can spot those problems kind of early on in the process. And they know that construction is a very nuanced industry, and you need to be working with somebody that has expertise in that industry in order to, to produce the financials and the tax returns in the way that, those users want to see them. I guess as far as how can contractors, tap into the same network, it's kind of like what I said earlier, that, not every CPA firm is a good fit for a contractor. Well, it's the same thing with like banks, right? Not every bank knows the construction industry well. And so they're not necessarily going to take chances on an industry that they don't understand well. They may still loan on it, but the terms may not be as favorable, and they may not give you the capacity that you need and things like that. So what I've found throughout my career is that once you have the relationship with the client as a CPA, you become really their go-to person for making introductions to other areas. Like, I feel like we become kind of the quarterback. And when it's a insurance question, we get those. When it's a HR question, we get those. When it's legal, those come our way too. And it's like, well, guys, that's not my area of expertise, but I know a person that I can introduce you to. So that becomes really, I think, important for us to have those, established networks, so that when a need for a client does come up, you can introduce them to the right person. And it should be somebody that shares that construction background and expertise, so that they can, again, properly serve them.
Yeah. When do you advise owners to hire their first controller or in-house accountant? What signals tell you it's time? And what's the job scorecard?
Yeah. So yeah, it's going to vary a little bit based on, I think, the contractor, and maybe what some of the owner's capabilities are. Really kind of how quickly they're growing and all that. I'll jump to the in-house accountant first. I think for most contractors, that's going to be a pretty early hire. Obviously, when you're starting out, if you're a solo kind of business owner, you're going to be doing everything. I mean, you're going to be doing all the billing, you're going to be reconciling QuickBooks, you're going to be paying the bills, but I think bringing somebody in-house to own, at a minimum, the receivables and payables functions is really important for small construction businesses. I think it's hard to outsource that. I know in other industries, outsourcing billings and bill pay is not uncommon. I think for construction, it's very hard, because you got to have sort of that institutional knowledge about the business, and you got to have direct communication with the people managing the jobs to know, like, can I actually bill for this? When can I bill for this? What vendors do we need to make sure, we're getting paid right away, and what vendors can maybe we take a little bit more time to pay. I think there's a lot of subtlety to it from a construction perspective. So I think as soon as the business owner starts to feel overwhelmed by, kind of those administrative accounting tasks, is when they should look to bring somebody in, even if it's part-time to start, before it grows into a full-time role. And most of the clients I work with, that person is, they have other responsibilities, under their job title within the office. I mean, they're probably handling payroll too. They're handling a lot of kind of phone calls as far as, like light sales and business development things and managing the office and all that. So I think that's very early in the business's life. You're looking to do that. Controller, I think, is going to really depend on how you as a business owner view the financial statements and kind of your opinions around the data that you're getting out of the financial statements. I don't know that I've seen very many contractors under 5 million have anybody in that capacity, and even beyond that, it's pretty hit or miss to me whether they start to bring in somebody in a controller capacity. I think they typically got that internal person that's handling like day-to-day accounting things. They may start to outsource some of the monthly close process and things like that to a CPA or like a fractional controller type firm. I would say at 5 million, it might be worth considering bringing somebody in house. But again, it's going to vary. If you do bring somebody in house, what I think that person should be responsible for is obviously, owning the whole month end close process, maintaining an accurate schedule of WIP, and making sure that's updated on a monthly basis. And then, probably doing some level of like cash flow forecasting. That starts to get into a bit of a CFO type responsibility, but I think, most controllers, full-time controllers, could handle things like that too.
Yeah. And number 5 million, that's something people can easily remember.
Yeah, and again, it's going to vary. I've seen $10 million contractors that don't have a true controller in place, so
Hmm.
it really, yeah, I don't know. I think it really boils down to the business owner and, again, how comfortable they are with the financials and their mindset around the money. Like, there are a lot of contractors that are kind of shoot from the hip type of people, and they're really not relying on the financials for much. They're looking at cash in the bank and making decisions based off of that. That's not what I would advise anybody to do, obviously. I mean, I think there's a lot of meaningful data points you can get from the financials, and I think you want to make informed decisions. But I think it's still an industry where there's a lot of people working off of their gut and not necessarily relying on the data.
Yeah. If you had to pick one KPI dashboard tile, each for the owner, PM, and AP lead, what would those three tiles be and why?
Yeah, so for the owner, I think I would encourage them to have a real good handle on cash flow. So I think I don't know if it's a KPI so much as I think they really need to be in tune with the cash flow forecast and where your net cash position is, because there's elements that go along with maintaining cash flow for the business that really the owner is going to have to be involved in. I mean, increases to the line of credit, draws on the line of credit. In a lot of cases, the owner calls up a customer and says, "Hey, I need to get paid right away, or we're going to, whatever the consequence is." That's going to carry a lot more weight than maybe your AR person or, somebody else making that phone call. So I think kind of net cash position relative to the cash flow forecast is something I think that an owner should have a lot of responsibility over. The PM, I think it's going to be kind of job profitability compared to our budget or our bid. I think really that's their job, is to make sure we're executing on the job and that we're maintaining profitability there. They're going to be responsible for the crew and making sure that the crew is getting through things efficiently. They're going to be responsible for, the materials and making sure that, we're purchasing things, and, staying on top of that. And then the third one was AP lead. I would say, yeah, really just, kind of days payable outstanding is, a key financial ratio that you're going to look at there. And, just evaluating again, are we paying our vendors strategically? It's not something that we need to, we don't need to pay bills as soon as they come in the door, right? They give us payment terms for a reason, and we need to take advantage of the payment terms that we have available to us to maintain cash flow. So, but at the flip side, I mean, you don't want to slow pay too much, otherwise your vendors are going to be unhappy with you. And so, maintaining that balance of, not expending cash or too much earlier than we need to, but keeping the relationships in shape is important.
Yeah. The next section here is on tools, workflow, and real world scenarios. A PM says, I can't find the invoice image from 3 months ago. What's your ideal source of truth setup? AP tool, ERP, file policy. So, what never stalls so that job meeting again?
Yeah, I mean, it's funny because again, it's kind of what is the ideal scenario versus what are people actually doing in practice. And I have been working with a number of my contractor clients over the last 6 to 9 months to just get them in the habit of maintaining accurate payables information. And it usually starts, kind of in client onboarding to say like, I see your receivables balance is here and your payables is significantly lower. What's the deal there? And it's like, well, we're not really recording bills in the accounting software. So training them up on like, okay, this is the process. We got to get the bills entered in there. We can't do any cash flow forecasting without it. And how are you guys even maintaining any sort of process for keeping track of who's getting paid and when? Typically off balance sheet, and there's a file, and the person goes through it weekly and kind of checks in on things and pays things as money comes in the door. And so I think that's the reality of the situation for a lot of contractors is they don't necessarily have a good process. I would say ideally, I think you should be at a minimum using your accounting system to record the bills, and really depending on the quantity of bills that you have coming through. If you're somebody that has dozens or hundreds of bills coming through in a month, you probably need to be using an AP tool, and those things need to interface with each other and communicate. So ideally, the invoices work their way into the accounting system in some fashion, whether it's directly working through the bill process or the module within the accounting software, or using an external bill pay platform, and it all kind of imports and links over. So I think the worst case scenario is obviously we have some physical paper file sitting somewhere, or is sitting in somebody's email, and we just have flags and an email folder where things go, and then they get moved out of there as they're paid. You really do need to have some process that links it into the accounting system so that whoever needs to access that information can access it, whether it's the business owner, whether it's like a internal AP clerk, bookkeeper, or whatever, it needs to exist, within the financial statements.
You get a set of books from a new client. Jobs look profitable, but cash is always thin. What's your forensic checklist to reconcile WIP, AR, aging, retention, and underbilling?
Yeah, so I mean, probably going to start with the WIP schedule and see if that's being maintained first off. Again, the reality of the situation is that there are a lot of small contractors that are not updating their WIP schedule on a consistent monthly basis, and that's really a habit that we should be adopting. And then if they are doing that, again, are they updating the financial statements for that? Most small contractors are not using like a robust construction specific, accounting software or ERP, type platform. They're, a lot of them are running QuickBooks, and the WIP schedule is an Excel separate of that. Again, at least with a lot of the businesses that I'm working with. And so they're going to have to be manually via journal entries updating that. And so I think we're starting there. We're looking at WIP. We're making sure it's being updated, within the financial statements. And, from there, I guess we're probably moving into AR and looking at, again, are we billing when we're supposed to be billing? Are we underbilled based on what the WIP schedule is telling us? Or, are we hopefully in an overbilled situation, but making sure that we're billing as soon as we're allowed to based on the terms of our contract. And again, that we're separating within our accounting software, like the retainage from like the regular billing, because we want to know, okay, if we bill for this much, how much are we realistically likely to collect in the short term versus what is going to sit in retainage, and it may take us potentially longer to get that collected. So I think that's kind of would be my process, is start with the WIP and then sort of work into the financials and then drill down into you know things like that.
It's so important. Play, fix this in 5 minutes. You open up P&L where materials is 60% higher than bid across multiple jobs. What 3 clicks do you make first?
Yeah, I like this question a lot. I mean, I think for me, I'm gonna just start by drilling into the detail on the materials, and we're gonna see are things being duplicated within the accounting software.
Hmm.
Are we manually entering like a payable in there, and then it's also importing from some other source? I mean, like you would be shocked like how often duplication of any type within accounting software. I mean, it could be on the AP front. I see it happening with payroll. I see mapping from, an external software into our accounting software that causes things to import. And then again, somebody's manually entering things like that and they're not matching the transactions up. So a duplication to me would be where I would start. I think it's the old KISS acronym, keep it simple, stupid, right? Where like let's try to focus on the most obvious solution and not overanalyze this. And I think duplication is where we're gonna potentially solve some problems there. From there, I would maybe start to see if things are being coded to the wrong job. Maybe we have jobs where materials are overstated, but then we have other jobs where there are very minimal materials recorded because we're not correctly coding things between the two different jobs. And I see this happen again. Small contractors, they buy materials for multiple jobs on one invoice. That single invoice gets coded to one of the jobs rather than splitting it up between all of the jobs where, we're using those different materials. So let's make sure we don't have jobs where our materials are understated. And then if we're kind of working through the most simple explanations, if neither of those are going to, really help us, I think then we start to kind of, drill down into if it's not like an accounting error or, some sort of system problem, what's happening with our purchasing. Like, did we make a mistake in our bidding? Like, did we somewhere along the process, fat finger something in the software? Do we fail to select something in the software and our bid is way off? Or, what's kind of happening there? Kind of drill down into like, are these prices right? Did we misquote something? Was there a change order that got missed? I think that's another big one, where, we originally set out to do this and then we have the change order and the change order is not getting passed along to, the accounting team or the in-office team. And so we're not accounting for these, things that are happening. The people in the field know what's going on, but the people maintaining the records don't.
Yeah, I really liked the flow you described.
Thank you.
The last section here, Cody, is entertainment and personality. Tax, court, or tool belt. Lightning round. Tell us which you'd rather tackle and why. Negotiating with an auditor, explaining WIP to a banker, or spending a day with a superintendent walking the site and tagging cost codes on the fly.
Yeah, well, it's definitely not negotiating with an auditor. That would definitely be the bottom of the list for me for sure. For me, yeah, out of those choices, like I would love to walk the job site more frequently. I would love to get out from behind a computer as somebody that sits at a desk most of the time. Any chance I have to get out there and kind of see what my clients are doing in real life, like out there on site, I think is very cool. That's part of why I love the cost segregation service line that we have, because you can get out there and you can walk through the buildings and you can kind of see how the different businesses are operating and just sort of the internal workings and all that. So yeah, for me, getting out there and walking the job site would be a real fun experience. Part of why I got into servicing, construction, as is, my family comes from construction. I had a grandpa that was a union carpenter for probably 25, 30 years. My other grandpa was a welder, and I got uncles that work in the industry. One's a road builder. One worked in plumbing and electrical. I have a cousin that does HVAC now. So I have a lot of family that's in the trades, and they're out there and working in the elements. And I get to sit in a nice climate controlled office, sitting in front of a computer. And so for me to get out there and really kind of see how my clients are operating on a day in and day out basis would be a
What about the explaining WIP to a banker?
Yeah. Well, it's funny that you mentioned that. I had coffee with a banker a couple months ago, and he was pitching to me that um, One of the things that really kind of sets his bank apart from other banks is they got their start in the construction industry. And, he feels like, their team has a really good handle on construction accounting and, they can look at a WIP and they can, make, informed decisions from that. And so yeah, I don't know. I think that would be a fun experience too. I love just, talking about accounting and tax for this industry. And so to get to kind of dive into that deep with folks that have a financial background, but maybe aren't in the weeds in quite the same way that, like I'm in the weeds on a regular basis. I think that could be really fun because you can kind of nerd out over some of that stuff and you can really kind of get into the nitty gritty of it. And yeah, I think that'd be a great time as well.
Thank you for coming onto the show. I had a good conversation with you.
Yeah, thank you very much, Rishi. Yeah, happy to have had the opportunity.
Thanks for listening to Finance with the Job Site. If you found today's conversation valuable, share it with a teammate and subscribe so you don't miss the next episode. You can listen on Apple Podcasts or Spotify or watch on YouTube. Just search Finance at the Job Site. Until next time, here is to building smarter, faster, and more profitable projects.